Well, good evening, everybody. Welcome to our Optionetics Fall Seminar Series or Webinar Series. I'm Tom Gentile. Glad to have you guys here. I was playing around with the with some of my screens here, and just starting to get into some of the new camera equipment I got in the room. Hi, everybody. I apologize. I know I'm about a second and a half behind my mouth from what's coming out of my voice. About a second and a half later, you'll see my mouth moving. But you won't be on here for long. We're going to play around with this camera stuff and try to get it more in sync. But what we've determined is it is the go-to webinar server itself that's behind. Because everything else I have seems to be working really well. Let me sharpen this up by going to our main screen. We're going to spend most of our time on this main screen tonight anyway. So welcome once again to all of you that are here. Again, we got a lot to cover over the next few weeks, and I will kind of build you along that way. So for those of you that are brand new Optionetics students that happen to find us in the last few months, I want to welcome you. I've got a couple of housekeeping things to get through. Take me a few minutes, and then we're going to get right into tonight's session. By the way, I'm going to show you guys something really cool that I've never done before. I've been short-term trading, mostly calls and puts, and it's a teaser because I'm going to show you next week how I'm doing it. All right, but I'm going to use tonight's the stuff I did the last couple of days as examples for those of you that kind of really need a refresher on calls and puts, but also showing you what I've done. Some of them were a couple of trades were duds, and some of the trades were really good. But you'll see what I'm talking about. The disclaimer you see on the screen, let me get through that real quick first. You can read this in its entirety. I've had it up now for the first few minutes of our presentation. All you got to do is pause it on the recording, which you will be getting as immediately following the live live webinar. You can read it in its entirety. All you got to do is hit pause, but I just want to mention two things. Number one, stock and options trading has large potential rewards, but also large potential risk. All right. Number two, myself, Jay Harris, and everyone associated with Optionetics or Tom's Trading Room, we are here as educators. So we teach you how it is that we trade. We're not investment advisors. We don't give specific trading advice. All right. And you obviously need a broker or an options broker to trade stocks and options. Everything I'm going to talk about tonight is in US dollars unless noted otherwise. So that being said, let's go ahead and move on. All right. So again, for those of you that are that haven't seen me in a while, welcome. You guys know my rap sheet. I've been doing this over 25 years. I co-founded Optionetics. We ended up with Optionetics. Hundreds of thousands of students have gone through the halls of Optionetics. Optionetics got into a partnership with Options Express, was sold to Options Express, later sold to Charles Schwab. I was at Schwab for a little while. A little while, it was a couple of years. Most recently, or in the last couple of years, I ended up getting Optionetics back. I thought it was better for me to bring that education back to you. They felt and I felt it was the best thing to do. And so here we are. All right. A few other things I do there too, tomgentile.com, which I put free articles on all the time and educational pieces, optionetics.com, obviously, and tomsoptiontools.com, which we'll be getting into later tonight. All right, welcome back, students. Optionetics still offers that free lifetime attendance, but now it's online. You don't have to drive to a hotel. You don't have to go into the city. You don't even have to dress up. All you got to do is show up online. But what we have done is I'm able to now do a couple of weekly webinars with you, and I do them typically anywhere from 2 to 4 times a year. All right, our last one we did was in June. I'm doing this one now. I'll probably do one just after the new year as well. This will be the last one that I do for the year. But a couple of other things I want to mention for those of you that remember Platinum. All right, Platinum has evolved to tomsoptiontools.com. If you really liked Platinum, you'll love tomsoptiontools.com. I'll get into it over the next couple of weeks, a little bit of what's the same and what's different. And of course, we offer some premium services. We call them mastery programs. I also have a once-a-year partner program. We do these. We only do one particular program per year per person. All right. So, and I've got one more coming up this year. It'll be the last program that we do for the year. I'll get into that in a couple of weeks. Our Trading Essentials webinars for this particular quarter are going to be today, next Tuesday, and the Tuesday, which is October 15th. The recordings are made available. They'll be emailed out to you as soon as the live event is over, and any handouts, including this slide deck, I'm going to make available to you as well. All right. Tonight, we're going to talk about stock selection, calls, puts, finding cheap and expensive options, and the Darknet strategy. When we get to week 2, I'll do a review of this week. We'll talk about spread trading, and we're going to trade with a money counter, and I've got a bonus piece I want to talk about with you on short-term trading options, okay? And then week 3, we're going to review weeks 1 and 2 and how to trade calendar spreads. Jeff Beamer will be joining me on week number 3. So, quick question to everybody out there. Are there any students on this webinar right now that day trade options or that short-term trade options? If you are one of those folks, if you could put a letter Y or say yes right in the Q&A box, that would be fantastic. I'm finding more and more, especially, and it tends to be millennials that do a lot of short-term trading in options, but short-term, long-term, whatever it is that you're doing, all right? Benjamin Franklin said it best: an investment in knowledge pays the best interest. And you gotta know what you're doing when you're short-term trading options. I mean, you really do. How many of you, and this is me, all right? If I'm going to short-term trade options, I actually like the ETFs sometimes better than the stocks. What do you think, Jeff? I'm far from a millennial myself, so I'm with you, buddy. But I like SPY, GLD, SLV. Those were a couple I've been into in just the last couple of days because they're so easy to get in and out of, and you can do some really interesting things with them. And I'm going to have fun with you guys next week. I'm going to talk about money counter next week, but I want to get into a little bit of short-term trading for those of you that are interested to see how I do it. I'm going to share that with you guys. But tonight, we're going to really just get into the foundations. And I do have, I see Amazon that's come up as a very interesting trading opportunity today, all right? Not yesterday, not last month, right now. So you're here at the right time. So Amazon has come up as a very interesting opportunity. There's another one I'm going to share with you even before that I think looks even better, and we'll take a look at that as well. But where do we start from? There's 20,000 stocks out in the universe, all right? 20,000 stocks. Where do you go? Where are your best tradable stocks? Best tradable stocks are in these areas: market liquidity, stock mobility, and they got to be short-term optional. And one area where you can find all three is at the cboe.org, all right? cboe.org is the Chicago Board Options Exchange. What you're doing is you're going to look for their penny pilot list. It's a downloadable list of stocks that have bids and offers on options inside the 5-cent window, okay? I mention this on every Optionetics event when we do week 1. This is where we start, all right? If you haven't done this, check it out. If you have not updated your list, you need to do so, because I update this list. I try to go in and update it at least quarterly. And if there's anything that's changed, because you'll get the list. And if you go, another way you can do is just Google it. All right, go to Google and type in Penny Pilot Program. And if you go, once you click on the little search button, the very first one that pops up is CBOE Hybrid Penny Pilot Program. Click on that link, and then it's gonna take you to the CBOE page. And the very first thing you'll see under Penny Pilot Program is click here for a .csv file of Penny Pilot classes. When you click on that, it will download that spreadsheet for you. And now you've got all the Penny Pilot stocks and options that you can work with, right? So what you've done, in essence, is you've taken the thousands and thousands of stocks and the 4,000 plus optionable stocks, and you brought that down to about 400 stocks. So you're really dealing with the top 10% of all optionable stocks. Now, why do we trade options? Well, that's simple. There's really three reasons. Controlling a lot of stock, all right, for a small amount of money. Number two, protection. All right, protection meaning that we can, in the case of if you're buying calls, you're buying puts. Well, guess what you're doing? You are now, if you're buying calls, you're protecting the majority of your cash going into a stock itself, right? In the event of a pullback, you have limited risk on options. If it's a put, maybe you're buying a put against a stock or portfolio. That's a different type of protection, right? That's insurance. And then there's other ways you can trade options to pay for protection, and those could be things like if you're selling call options against stock, if you're selling credit spreads, if you're doing butterflies where you're putting together a strategy that that allows you to really mitigate the cost of the options. And one more really good one is a calendar spread, because it allows you to do what's called continuation trades and roll out. And we're going to cover those in week 3. All right. So 2 types of options, calls and puts. I'm not going to spend a lot of time on this because I'm going to, assume all of our optionetic students in here know something about options. And you've got calls, which are give you the right to buy, puts give you the right to sell. And we're going to talk about the buy side of these. And what I'm talking about is going long calls or going long puts, meaning we're going to buy them, not open sell, but buy to open, right? Most countries have what's called the 1 to 100 contract size. Now, used to just be in the United States and a couple other countries, but now it's mostly everywhere. But there are a few countries that still have the contract size, which is good for 1,000 shares, all right, 1,000 shares of stock. But right now, everything I trade is 1 to 100, all right? Now, the strike price, that's just the price agreed upon between the buyer and seller. The buyer can exercise that option contract for stock at any time up to expiration using what we call an American exercised option. Expiration dates are the only other big thing about options that I think of when I'm thinking about the primary basics of options, all right? And this has gotten to be, from the time I started trading options until more recently, has become quite an interesting one. We've got, we started with third Friday options, and they weren't even every month. They were third Friday options, and then sometimes you skipped a month or two depending on the cycle they were in. But now options expire on almost the third Friday of each month. There are weeklies which expire each Friday for certain stocks, and then there are certain ETFs that expire on Monday, Wednesday, and Friday. So we've got those. We've got end of month options. We have quarterly options, and we have leap options. So which ones are best? Well, they're all best based on what type of strategy you're doing. If you're a short-term trader, you're looking at those Monday, Wednesday, Friday options, those weeklies. All right. If you're an income trader and you're looking at that 30-day trade, then you really are going to be looking at options that expire. You could look at weeklies into the following month, but typically you'll look at those third Friday options. And if you're looking for something that's outside of that, then you'll look at 90-day options or 6-month options or even leaps. Leaps, which are what are called long-term equity anticipations, that's just a big word or a big sentence for long-term options that expire with 9 months or greater to expiration. All right. The only other definitions that we talk about when we cover options, and I like to see these on graphs. I like to see these when I'm actually putting trades together, are in the money, out of the money, at the money options. In the money have mostly real value. By the way, I like those on short term. If I'm buying a call option or I'm buying a put option and I'm planning on getting out of it, especially if I'm getting out of it the same day, I'm more than likely going to be in the money. All right. Out of the money options, I love selling those. Those don't have any real value. I like to sell those, and typically I like to sell those against something I'm buying. At the money options are really, they don't have any real value, but they have a very high gamma, which means they can go from at the money to in the money, or from at the money to out of the money real quick. They are the most popular options, so the at the monies. I like these when I'm buying puts, right? I like the in the monies when I'm buying calls. And these are just on short-term things. And I'm just rattling them off the top of my head. The other thing you got to pay attention to is volatility. And volatility is the speed at which a stock is relative to its time. So there's two types of volatility we use when we look at stock movement. Statistical, which is past stock movement, and implied, which is present option pricing. Okay, now I want to show you an example of the two of those. So let's go over here. All right, now I'm actually going to be in Tom's option tools back and forth for the better part of the hour. And if we're going to look in here, the first thing I want to show you is if you go to, let's go to a stock chart. And we're going to be looking at Amazon a lot tonight. So let's type in AMZN. Right now I can do a lot with Amazon. First of all, I can see the stock is now coming back. It's coming down. This is a 60-day chart, so this is only the last 60 days, but it is hitting some interesting support. These dotted lines you see here are what we call stock chart peaks, peak highs and peak lows. All right, we use closing prices based off of one of our formulas here at Tom's Option Tools, and we're hitting some very interesting support right now on Amazon. So this is this is one way we can look at a chart. The other thing I can do is I can come over here and I can look at channels. So we have the ability to test channels looking at Amazon. Now, Amazon, we've immediately jumped to a 104-day chart because that's what we need to run the channels. And the channels right now are showing longer term trend down and a shorter term, almost like a pause that's going on here between lower lows, and this is where again we're potentially bouncing off these lower lows that you see here. All right, but what I also want to show you is if we come in and we look at different types of charts, I can put a probability chart up and use what we call probability cones. All right, now let's update that, and you'll see here's Amazon. Now the probability cones are based on what this has done in the past. All right, it uses past volatility, what's called statistical volatility, to give us an idea of the range that the stock price will be in between now going forward in time. This is 1 day in time, 22 days, 43 days, etc. All right, so this is good to know when we're looking at potentially maybe what options we want to consider buying. But that's an idea of one idea of statistical volatility. If we want to look at implied volatility, then I come over here to my options, or better yet, I can bring up the stock chart of Amazon, and right below it, let me go ahead and update this. And right below it, I'm going to put an implied volatility, or looking at the actual options. Now, what does this tell me? First, we have the candlestick of Amazon going up and down, but you got a red line on here too. This red line represents all of the 7 to 30 day options that are at the money each and every day. And what we do is we calculate an implied volatility number on it each day, and we're able to actually create lines out of this. So as you see back here in August, the options values were very expensive for Amazon when you compare them to where they were at the middle of September, right? An 18% volatility in September versus a 36% volatility, all right? Double. The time premium was twice as expensive here for a 7 to 30 day option as it was here, all right? You can see lows to highs. Now, where are we at right now? Well, we're not exactly low, but we're not exactly high. So Amazon is starting to creep up in implied volatility. So that tells me that I might want to consider different option strategies and not just go for the first thing that I see, all right? But that's implied volatility. So next, so I want to throw you what happens when you put some of these option trades on, okay? So I'm going to get into actually creating one of these. Even though the market's closed, I'll show you kind of how you put these together. These were day-only orders that I put out. This one was I think it was Friday of last week. So this was Microsoft. Okay, just buying the 138 call, and this one went from 1:10 p.m. to 3:50 p.m. You can see a little bit of a bump there, right? 148 to 186. All right, that was 38 cents. All right, times 10, that's $380 for that particular trade. Here's SLV, and this one was really a dud. I mean, it was a 20 contract trade, 44 cents. This was at 12:03, 2.5 hours later, 45 cents. But hey, it didn't lose a lot of money, just didn't make a lot of money. All right. Puts have the same characteristics as long calls, but in down markets. They have the same 1/100 contract size as calls. They have the same number of strike prices and expiration dates as calls, but puts increase in value as the stock price decreases. So here's an example. All right, this is one I did today, actually. So today I bought S&P puts, okay? Market was falling. It was we had trended down pretty much all day. I mean, any of you that watched the market today, we opened higher and we just started dropping from there. All right. Then I had a pattern that told me, you know what, 12:30 is a good time to sell. So I bought puts. All right. And so I threw 10 contracts on these S&P 296 puts, and about an hour and 5 minutes later, they went from 226 to 302. And I sold them, all right? And there was a time frame, a time pattern I was looking at here, buying them and then turning around and selling them. And you know, what a nice little move that was. That ended up being, I want to say it was about $700, all right, on 10 contracts, which was a nice little day there for a small trade, all right? I mean, you look at, okay, so some of you that may be looking at this that are newer might say, well, what did that cost you? All right, $2.26, which is really $2,260 for 10 contracts. All right, but if you could take a $2,260 position and increase it by $700 in a little more than an hour, you know, you're talking about 246. That's a 30% return in an hour. All right, I'll take those all day long, and you don't need to do big amounts of those to see some really nice gains as we're moving along. So at this point, what we've done is we've talked about calls, we've talked about puts. Oh, I wanted to show you guys, how do you know what's expensive and what's cheap? All right, that's a question that just came up, and thank you very much. I meant to show that before we hit the stop button. Here's how I do it. So I go to options, and we have this thing called rankers at Tom's Tools, and then we can go to pre-computed implied volatility ranks. So this shows me what's expensive and what's cheap. So over the last year, all right, you know, take a look at, all right, the weather in New York. So I'm up in New York right now. We're going to be up here a couple more weeks, and then we're going to fly back to Florida. But I'm in New York, and it's actually been really warm here. All right. In fact, a couple of days ago, I think the high was like 87. And for the end of September, that's pretty much the high. I mean, that's I'm not saying it's a record high, but it's higher than it normally is. Typically, you know, the afternoons are like in the low 70s as you get into the end of September, but we were in the high 80s. So that's higher than normal. All right. Well, the way we pick options is very similar. What we do is we look at percentiles. We see what's the, you know, where's it been over the entire year in terms of options. Where have they been their cheapest? Where have they been their most expensive? And where are they at now? So look at Stitch Fix. Now, Stitch Fix announced earnings today, so that's why their implied volatility was so high. But look, 148.42, and the low was 45.19, and today was 148.42. I bet tomorrow this number is going to drop. But take a look at these other expensive stock options. Costco, expensive. Tupperware, expensive. All right. Bygene, expensive. Halliburton is not as expensive as it was, because this is the high, 56.06. This is the low for the year, 25.68, and this is where it is as of today's close. So you can kind of see what's on the high side. All right. Well, what's cheap? Well, we can go over here and we can click on cheap for 1 year. And here's what's cheap right now. Enanta Pharmaceuticals, high 82, low 42, last 42. Rent-A-Center, high 176, low 35, last 40. Right? Summit Materials, Campbell Soup, 55.51 was the high, 21.05 is the low, 23.82. Right? And then it's just a matter of if I want to look at, do some more information on Campbell Soup, I can get a chart of Campbell right here. And it's got its Bollinger Bands, as you can see right there on the chart itself. But Campbell's has been moving up. And we're talking about something that was down here at 35. I'm going to talk about these buys and sells here in a few minutes, but 35, and now we're looking at the high 40s. Very interesting that something as boring as soup which, by the way, earlier in the year, everybody hated Campbell's soup. You couldn't hear enough bad news about it. But look at the volatilities. Here's the volatilities where they were high, trading around 55, all right, back in around the beginning of June, and then again around the beginning of September. June, July, August, September. These are 3 months apart. What do you want to bet these 3 months happen to be the time that earnings, yes, came out? So when we get close to earnings, Campbell Soup's options go up in value. And then when we come out of earnings, they go down. All right, but the stock has been rising very nicely. So that's how I go through and I take a look at what's cheap and what's expensive. Is I use under options, go to rankers, and you can use the pre-computed rankings that are right there. So you can see what's expensive. It defaults to expensive. And if I want to look at cheap, I can look at cheap. I can also look at explosive and quiet stocks. I can look at breakout highs and breakout lows. And I've got all kinds of other rankings that I can go in and analyze. All right. Jay Bird, are you there? Because I'm at a point where if you have any questions, I'm happy to answer them right now before we get into
Eugenie is asking
Darknet.
for a reminder as to how you get the pre-computed stock list.
But I answered that, right?
List. I thought you did, but you need it answered again, Eugenia? I'll ask her and see if she needs it answered again.
Absolutely. Options, you just log in, you go to options and go to pre-computed list, and you're there. All right.
Okay, and then this isn't a question, but it was an interesting thing brought up by a student earlier when you're talking about contract size, the 1 to 100. He was asking about the minis, the 1 to 10s, and there's only like 4 securities: Google, Amazon, SGY, and GOD. Do we have?
I don't trade those because they haven't been out long enough for me to really get a good evaluation on them, and they don't have a lot of volume. And usually, when something doesn't have a lot of volume, then you know my take on it. I don't want anything to do with it because I want to be a small fish in a big pond, not the other way around. But I mean, it's not that you can't do them. I think it's a great way to get your feet wet. But just be careful on the difference between the bid and the ask spread. There's plenty of good stuff out there that you can buy and sell, especially in the ETF categories, that is cheap. I mean, I was buying SLV calls today, and I think they were trading like 37, 45 cents. I mean, they were cheap, 45 cents. We're talking about $45 for an option. I mean, I can't get a good meal in New York for that price.
Right. So. And then what expiration did you have, or how much time did you buy on the put today?
I typically use like Friday expirations, but then yesterday I was actually using Monday expirations on a Monday trade because my idea is if I plan on getting out a couple hours later, then I'm perfectly fine using an option that expires later that day. So again, it's all about getting the gamma when you're using short-term options, right? But I was using that, Jay, and everyone else. I was just using it as an example of what it would look like buying or selling a put, whether it's in the same day, the same week, the same month. You've got to buy to open and you've got to sell to close. And we're going to do that together here with the next example that I have with Darknet.
And then last, and I'll answer Mark on the Q&A board, but Mark was saying, is there a way to export lists to integrated investor? We're not using integrated investor here. Yeah, okay.
That I don't know, but a good question. If you find it, Jay.
Lists from other sites into our tools. There's videos in our video library that explain that, Mark. But I didn't see the integrated investor part, Tom. I wouldn't have asked that on the session.
Oh yeah, no, that's no problem.
Okay,
that's
all right.
Problem. I mean, typically what I end up doing is, the easiest thing to do, and it's probably kind of crude, is the cut and paste feature, where I just cut them out and then I paste them into an Excel spreadsheet, or I'll take the penny pallet list stocks and I'll copy all the symbols and I'll stick them right in. I'll show you where I stick them. Website, I go to lists and I can actually create a list. And I'll stick them right into a list. And here's my stock list, but I create a list that I call pennies and weeklies. And all I do is I take that list and I shove them in there. Right now, I got 586 stocks in there. These are all stocks and ETFs. That's the whole shebang right there. But I got that list from the penny pallet list that I showed you how to get at cboe.org. All right. So let's move on to Darknet, because that's what we're going to talk about tonight. I use the triangle theory of trading, and that's spot the opportunity, create the low risk trade, and then plan, execute, and manage. And tonight we're going to talk about Darknet signals. So Darknet is our contrarian trading strategy. I like to say it's similar to Elliott Wave. And with Elliott Wave, Elliott Wave is a complex strategy. It's a series of wave counts that go from 1 to 5 impulse waves, and then they're followed by correction waves, which are usually ABCs. They're objective, and what I mean by objective is they move. If you get a new high or a new low, the wave count can change, sometimes change quite a bit. That's the one thing I didn't like about Elliott Wave, is that the wave counts change a lot. Darknet is similar in so much that it is a contrarian strategy. We use channels, right? We use what we call Darknet channels. And Darknet was actually featured a few years back in Stocks and Commodities magazine. And so where it differs is that the signals stay where they are. Win, lose, or draw, that signal's not moving once we get a channel collision. So when we get channel collisions, and that's where you have long, short, and intermediate term channels all kind of colliding either for a buy or sell, then that's where we get our signals. It's a buying strategy only, because we did back tests for years on Darknet, and we found that the best signals were the bullish signals. They were so much better than the ones that were bearish, but there are stocks that go up when the market goes down, and those are also part of the Darknet strategy. So, when you see a Darknet buy, you could be seeing a Darknet buy happening right before a bear market on a stock that's pulled back that could ultimately go higher. So this is an example of what we call a channel collision. As you can see here, you've got an uptrend that's happening, and you've got a pullback. You've got an uptrend that's in red, you've got a sideways moving channel in green, and you've got a downtrend channel in blue. And notice that they're all coming together in this point, where long, short, and intermediate term are all getting really close to colliding together, right? And that gives us that Darknet buy. Now, what you'll see on the screen, if you're using our contrarian trading software, you'll see these little B's and a little dot, which indicate where the buy signal came. All right, now I'll bound it back up again. Same chart. Here's Coca-Cola, all right, with the channels drawn in. Here's Coca-Cola, where the computer is picking the buys and sells. And you can see here, now the ones in the back on the left-hand side of the screen were past channels going up and down. And you see the buys, you see the sells. For Coke, there was a short-term buy at around below 43.5 and went up to like 44 and change. Then there was another buy that occurred back in March, down around 42.5. That went as high as 45, and then nothing. And then all of a sudden, here comes the buy signal again on a more recent look at the graph at 44.5. So what ends up happening is that each day we get a list of stocks that have met one of our Darknet buy criterias, right? We can get them in terms of stocks only. We can get them in a list like this that shows stocks and also option trades. And we're going to get potentially three different types of trades, right? If you notice right here where it says type, I have three things that could pop up. A B, which means that's a buy, all right? That's the first buy on that stock. If stock moves up or sideways or even down, and it comes into another channel collision and it still has a buy signal, it's not exited, we could get an R, which we call a rebuy. That's a second signal on the same stock, having one entry already. And then we can actually get a third, which is called an add-on, or we're given an A for that particular symbol itself. All right, so let's go through and I'll show you some case studies. And we're going to look at today. We're not going to go back in time. That you can go back and back test Darknet by changing the date in the upper right-hand corner and looking at Darknet stocks as they go day by day by day. I thought what we could do is look at today's stocks that came into the close of today. So to do that, I'm going to pop on over. I'm in Tom's Tools. Let me show you where I am. If I go home, so when you log in, typically you'll get this. All right, this is the front page. This is all of our option data right here. And then we have what's called the contrarian trader, and we have Alpha 9 Darknet. If you click on that, that's going to bring up the Darknet signals for today. And there are several. I mean, you look across here, we've got a bunch. So where do you go? And then I also have ones that say stocks and lists with Darknet stop signals. These are signals that were sells. So we'll take a look at those as well. All right. But in fact, let's take a look at the sells first. So PLT, Plantronics. So Plantronics had a buy signal given to us back in the middle of August, and that was down here around 28. Look at the lift that this had, and the sell came up here at 38, so a nice move up to the top there before the pullback on Plantronics. GFI, this is Goldfields. Goldfields had a buy. Notice that there was that we had that pullback. We came back into the pullback area here. This was a $4.60 stock. Sometimes trading stocks is plenty. You know, when you got something that's this cheap, buy at 460. The sell came around $5.20, between 5 and 5.20. ENS. All right, this is a more expensive stock, but you can see here it had a buy signal. Then look what happened. This was now I'm going all the way back to the beginning. So this is in the beginning of March. Buy signal just above 68. A rebuy came in at 63, and then a sell above 70. So the buy made a little bit of money. The rebuy made a nice chunk of change there. You had a buy at 61. You had a rebuy at 59, and you had a sell at 66. Now, what's the pattern that we're seeing with ENS? The pattern is it has a lot of rebuys. All right, it has a lot of movement. Well, the last signal was a buy signal that came in around 57, and the sell signal came today at 66. All right, so that is ENS, and I can just kind of continue to go on, and I can see, you know, here's MDRX, little bitty move right there over a couple of days from now. This is a $9.50 stock that became a $10 stock. That became a $9.50 stock. Actually, it was 10.5 on the buy, 9.5 on the rebuy, and then popped up here to around 11 for the sell, right? So that was MDRX. AZN. Well, AZN has had a colorful past. About 39.5 buy. Here's a 37.5 rebuy. Here is a 41 sell. Here's a 43 buy and a 44 sell. And of course, MMSI. Wow. Okay, this is an example one didn't do so hot. I mean, they're not 100%, but I'm showing you everything that's happened today. Here's a buy. Wow, right before earnings. Kaplunk, and we're talking about a $55 stock. It sold it at 40. Then there was the buy at 36, a rebuy at 34, and the sell came in at 30. So again, this is a stock, MMSI, Merit Medical Systems, that did not prove well. So one of the things that we can do is we can go look and see what they've done in the past before we go any farther into the future. What I like to do, and I tell people when you get a lot of them, and there's quite a few on here today, you know, you can see here that as I'm going across here, C-Trip, FXE, now some of these just have the stock symbol. Then you come along here to AMD, and there's the R for the rebuy. There's IHF, there's the A for the add-on, which means this is the third signal. We'll look at each of these, all right? But there's one on here out of all of them that I really like, okay? And I want you to put the symbol in that you like, all right? All of you here tonight, I'm gonna go through each one, and when you see something that you like, you throw that symbol in there, okay? Let's start with C-Trip. I'm gonna move this to the top of the screen so we can go through each one. So C-Trip, you know, I look at it, buy, rebuy, add-on. Boy, that was, I mean, you know, 43, 38, 33, and then finally pulled back, and you get the sell back here around 39. So that might have been a break even when you add the loser, the break even, and the winner all together. Then there was a buy and a sell, and look at this drop to new lows, and we have a buy here today. All right, let's look at FXE. This is the Currency Shares Euro Trust. Buy, sell, little winner. Buy, rebuy, sell, that was a loser, and you got the buy that came in today. All right, let's continue on. Hess. Hess, Hess. Don't they make the plastic green trucks, Jay, that all the kids love? They get those around Christmas time. I'm in an early era. I used to love the Hess truck. Okay, we know what Hess does. Buy around 61, sell around 62. You got to buy right here. This thing's herky-jerky all over the place. Amazon. I see already seeing people put Amazon in there. AMZN, AMZN. I mean, some of you guys are putting it in so fast, you're spelling it wrong. But buy, sell, buy, sell, buy, sell. Looks like it makes quick trades. I want you to think about that. All right. The average trade looks like it's only been maybe 2 weeks at the most. So this buy that comes up, this could be a short-term trade. All right. I'm going to go through the rest of the charts. We will be looking at Amazon, but that is not the one that most excites me. Okay. Kathy, you got a great question, and the reason I'm picking it out is I apologize because there's no way I can answer all your questions tonight, guys. There are so many people here, but you're asking a really good question. What's the depth of the color mean? That just means what the stock did today. All right, if it's green, it means it closed higher than it opened. If it's red, that means it closed lower than it opened. So look at CHK, okay? CHK is kind of hard to see here, but if I scroll way in, you'll see it's a red candle. It opened high, and then it closed lower. Right, so that's why you see that red on the screen. Where if we look at C-Trip, all right, look at C-Trip, and you can see that it did an open and it closed higher. Although that was a pretty good close on a day like today, where we were down 300 and some odd points. All right, MGM. Jay, I'll be at MGM this weekend. Going to Vegas.
Enjoy.
Ah, man, gonna taking the wife out there. You know, a little business, a little bit of fun. Buy, sell, not much of a big move there. It has jumped. It did jump from 24 up to like 31 and pull back, and it's kind of running into some nice double bottom here. This might be a pretty good, interesting play. Not the one that I'm most excited about. All right, ALXN, really big downtrend. Buy, sell, winner. Buy, sell. That was really maybe a break even. You got to buy down here near double bottom, perhaps. PTR, buy, rebuy, sell. That was a little bit of a loser. Buy, rebuy, sell. That looks like between those three was a small winner. And you get a buy in here today. It is higher than the low that happened back in August. That's not bad. PetroChina. WB, Weibo Corp. All right, so you got some buy, rebuy, sell, profitable, buy, rebuy, add-on, sell. Okay, well, the add-on was profitable, the rebuy was profitable, but the original buy was not. So you had to take all three trades to pick the profit up there. Buy signal today. It is higher than it was back in August. That's something to be said. GXC, can someone say head and shoulders bottom? Buy, rebuy, sell, buy, sell. I mean, they look pretty good, but I see a lot of air in between the days here, which means if that's the case, imagine what the options software is going or the options is going to look like. Anthem. Oh, maybe some of you didn't spell Amazon wrong. Maybe some of you really liked Anthem. All right, so Anthem had a buy and a sell, quickie, and it's got a buy right now. AMD. My son loves AMD. Him and his cousins trade AM. They're the day traders of the family. You know, I try to do a little bit here or there, but these guys are looking at this stuff all day long. I don't have the patience to look at the screen as long as they do. I'm going to show you how I day trade, and you don't have to look at the screen that long. I'm going to do that next week. But buy, rebuy. There is a double bottom going on here with AMD. Should be interesting to see what happens. PAA. Yeah, there was a winner. This is Plains All American winner. Here's a buy and a sell. That was a break even. Here's a buy today. IHF. That's an add-on. That means you got a buy, a rebuy, and an add-on. So your buy was at 175, your rebuy was at 165, your add-on was below 160. Last couple signals we had were there was a winner back in February and there was a winner in April. So it does have a good winning streak, but haven't seen it go this long in a trade, at least on the screen that we see here. CPRT. Does anybody in here like that trade? You like the chart? There was a buy that happened back in April or in August, and then that was at 74, and the sell came in at 84, and we had a pullback and we got a buy. What do you think about that?
Yeah.
That is my winner chicken dinner when it comes to charts. It's the best looking, it's the strongest, it's held up in thick and thin. Earnings are in 49 days, so you don't have to worry about going through earnings. Last earnings report we had, though, was a good one, so it potentially could be strong heading into earnings, but it looks like if we stay with anything that's less than 49 days to expiration, that might be worth doing.
Yeah, I like that old resistance at 80, looking like new support here at 80.
Yeah, and so you know what, Jay? I'm going to stop right there because I already gave away the chart. So that's the chart, but I go through each of these and I look at them, and I'm really trying to find strength. And I find that, if you get a bunch, if you get a few, you don't have the luxury of being able to sort through. But we have a lot that happens, so I like to sort through. I like Amazon because Amazon has just been hitting these areas right here around 1700. Right, 1700 became resistance, then it became support. Right, and now we came down near 1700 and bounced off it today and moved higher we were opened around 1750, pulled back a little bit, but this one could be a very interesting different type of trade. All right, any of you that like credit spreads, that's what I like with Amazon. Is I like the shorter term credit spreads. This could be something you could look at the October out of the monies, maybe if you went out to like August 18th, which is 2 weeks from this Friday, and maybe looking at the 1650, 1700s, your reward to risk ratio is going to look terrible, but your probability is going to look good. Okay, but that's Amazon. But I am going to spend some time taking it to the next level with CPRT. So once we get to this point, what I like to do then is I like to focus on creating that low risk trade. Now let's do some damage control here. This is notice resistance became support, right? Your 80, which was resistance back here in the end of July, became support just recently. All right. We also know that we are at 80 and that the high, all-time high, or at least for what we see now, is 84. There could be some continued pressure if we get above 84 to move up a little higher. I'd say 85 looks like a good target over the next 30 days, give or take a little. Right, so let's move to a stock and option table, which I've already done for us. You can see here I've got in today's date, CPRT. This right here just tells me, show me the stock price, the options that are 10% above and 10% below the stock price. All right, and I'm looking at October and November. And so as I do that, this is what I have available. Got the 75, 80, and 85s. These are all within the 10% variance above and below the stock price. So I could, if I looked at, for instance, first of all, if I looked at the 75 calls, and if I could get those for 5 points, all right, if that's that, because I like that $5 or less. So if I could buy one of those and I could buy it for $5, let's look at a risk graph of that. There's a reason why I actually kind of like this trade right here. Now let's say I'm going to limit this in at 5. You never know, it might get filled. It's amazing how some of these things work. So this is 5, so that means $500 in my risk. But what I want to do is I want to say, where is my reward if we come back up to 84? Now I could come along here and just drop my mouse right there. So it shows me that at that level, I'm sitting on, well, just above 84. All right, we've got profit there. Let me hit that button and make sure I'm getting something here. There, $400. All right, $400 profit, well, a little bit more, $450 at $84.40. So we really need to get to around 85 to really have the chance to double in value here. All right, remember, you might say, well, wait a minute, it's only a 5-point move and your option cost $5. Yes, it did, but it was a 75 call. At 85, it's worth 10 minimum. So the reason I like this, and let's go down here. Here's my volatility. It's low. All right. It looks like it's starting to move higher. And if I come down here and I go into the stock limits, and let's make 85 my stock limit high. Let me look at that chart one more time. 70. So the chart really is hovering around 70, and I'm going to put for a low, and I'm putting 85 as a high. I'm going to reset the risk graph because I just want to open this up. It's like getting closer to the window to see the squirrel outside. All right, that's what my cat does. So I can see here that if we go below 75, we do it today, we're going to be down about maybe $300. But if it happens over the next couple weeks, we could be down 500, but risk no more. But look where the stock is right now. If all it did was sat still and went nowhere, the most I could lose is about 35. I really have such a low amount of time premium in here, all right? So if you want to use an option that really is a surrogate for the stock, then you use an in-the-money call option. And you don't have to go that far in the money with this one, 75. You're going 5 points in the money, and you're literally getting this thing for $5. Where's the stock closed at? The stock closed at 79.53. So you really have about 47 cents. Is that right? 47 cents of time value, and you got $4 and change that's real. Look at your delta, 83.37. That means that you've got a stock that if it moves in the direction you want it to, the option is going to move 83 cents for every dollar that the stock goes up. The option should go up by 83 cents, and that actually gets better when you go in the money. All right, so that's the first thing I'm looking at, is that in the money call option makes a lot of sense. Because you know what? There's nothing on it that I hate more than being right on something and then losing money on the option. And if you're going to be in something longer than a couple of hours, which this one, you're looking at, this is 17 days to expiration. So you really got a couple of weeks in here. So that's the one thing I could look at. Now, if you want a little more time, let's go back to the option table for a moment. Then might I suggest the November options? Now, you can't get the November 75 calls for $5. They're trading 550 by 6. That's a fairly wide bid-ask spread anyway. But if you look here, the November 80s, which are 265 by 275, that's not bad. Okay, so let's go in and let me clear out the trade in October, and let's look at the 80 calls. I'm gonna put one of those in. Let me hit the risk graph there. So now what I'm looking at is I'm looking at an option that's going to cost $270, but it has 45 days to expiration. So I've got more time on my side to be right. If we go up to 85, all right, if we go up to 85 like soon, like today, even in the next 15 days, 2 weeks, we could come very close to doubling our money. In fact, at 85, we would double our money. But if it takes 30 days for this to happen, that I'm all the way out here, I'm going to make a little, at the $85 level, I can make, I'm trying to get it there, $255, all right, on cost of 270. So as you can see here, we really need this stock to move, or else we start dripping away at time. Where on our October position, what's more risk? Do we have time risk or do we have price risk? All right, when you look at the risk graph I just showed you, this one, the $5 option, that's price risk. That means that the price goes down, it's risky. If it goes up, that's great. If it goes sideways, we don't really make or lose anything. But if you look at the November at the money options, you do have some price risk, but you have time risk as well. All right, and that's what your delta tells you. Okay. So, Jay, questions? Jay.
People are looking at open interest. Do you factor that in your process?
No, I don't. The most important thing is not volume or open interest, it's the spread. It's the difference between the bid and the offer, because options are very fickle in terms of volume. I mean, let's go back and look at the option tables, and you can see here. Now, this one had the most volume and the most open interest, the October 80s. Look at those OC 75s. They were just two volume and 315 open interest. But it's the bid and the offer that tell me that there's something out there to be filled. All right. Now, yes, when you get to the at the monies and the out of the money options, there's going to be more. There's going to be more volume. There's going to be more open interest because they're cheaper. The bids and offers are closer together, but more importantly, they're cheaper, which means that doesn't always mean that's what you want to go out and buy, right? When it comes to put options, if I'm bearish on something, I will choose an at the money option. I sometimes will choose an out of the money option, but it's going to be short term. I don't plan on hanging out in those trades for very long. All right. So that's our Darknet case studies.
Tom,
Yes.
if I can interject, one of the benefits of this Darknet as well is when you get the list of candidates, both stocks and ETFs, it's going to show you an option with a percent to double. Tom's showing you another way to do that. One of the other filters for our Darknet stocks is our slippage. So it takes into account what Tom's talking about, guys, with that bid-ask spread of the options compared to the stock price. And if it doesn't meet our slippage criteria, which is the best indication for liquidity, even above open interest, then it won't even populate on the list. But that slippage column is there for a reason. It's to help you understand that you have that call option trade with a really tight slippage or bid-ask spread that's going to help you out.
Absolutely. Thank you, Jay. And you can get that by coming up here where it says stock only list trades. If I go to call option trades and then click search again, it's going to give you that list of stocks that fit the description of those calls. And you can see here that 16 stocks have call option ideas. They also have slippage. I like anything that's below 1%. All right. You get and you can see here the CPRT, the Copart trade. Those are 0.6%. Look at ALXN, 1.3%. ICUI, 1.1%. CNX, 1.3%. I don't care for those. The slippage is too wide. 1% or less is what I like for slippage. Your IV rank is just going to tell you how cheap or expensive those options are. That number will go from 0 to 100, somewhere in between. Obviously, above 50 it gets expensive, below 50 it gets cheap. Your delta just tells you the rate of speed that the option is going to change relative to the stock price. And percent to double is what these are ranked by. So notice the FXE trade we only need a 2.06% move in FXE in order for this option here to theoretically double in value. As they get real expensive down here, it just starts showing you that you've got to go. Now, if you look at the Copart trade, November 15th, 75 call. I mean, literally, it's telling you go out there and look at the November call option. But the November call option is going to cost you that additional, there's going to be over $1 in time premium in there. That's why you see the 76% delta. 76% of that option is real, and the rest is time. And you need an 8.76% move to see a double in this particular option itself. I like the October, but also it does have less time to expiration. That's the only downside to it. But this is what Jay was referring to right here. Now, I want to show you guys something new for 2019, especially those of you that are tool users, is that we have new for 2019, we've got a Darknet app. And so as part of our tools, we are now releasing the Darknet app. If you have the Darknet as part of your Tom's Option Tools package, we now have the apps available, and the apps are, you can use them on any smart device that's an Android or an iPhone, right? And I just took these and I clipped these off my phone and put them up on the screen tonight so you can see them. But here are some trades. These were trades off of the 30th. Okay, not to the end of the day. I had to put these in earlier today so that I'd have them ready for you. But you can get an idea of this is off my iPhone, and then if I click on one of these with my finger, I can flip the phone sideways and I can actually see the signals as they come into play. All right, again, phones, tablets, they work on those. This is the new updates that we've had for 2019, and wanted to be sure that everybody knew about those. All right. Hey, homework for this week. So I want you to follow look at the trade in Amazon. And you know what? We didn't really do a trade in Amazon. So let's take a look at Amazon real quick before I get into that. And the reason why is because you take a look at this. This is a $76 position. $7,637.50 for what? The November or excuse me, the October 25th 1700 call. Look at the spread between these things, 72 by 80. All right. You know what your homework's going to be? Number one, find me a better trade than buying these Amazon call options, because there definitely is one out there. All right, I mentioned credit spreads as an example, but find something that fits your risk tolerance. There's no way I'm going to trade a $76 call option. The only way I trade a $76 call option, guys, is if I bought it earlier for a lot less and now I've got to sell it and it's $76. That's how I'll trade a $76 call option. But that's the first homework assignment is follow the case studies. We talked about Amazon, find me a better trade. We talked about CPRT, follow that trade. All right. If you want to watch the Darknet videos, some more of the details, we have them at tomsoptiontools.com. It's in the free video section. And then also for new subscribers, check out our option tools at tomgentile.com/trading tools, and you can see the different levels. I'm going to click on this now. And by the way, let's put that right out there for everybody to see in the chat box. I'll put that out there for everybody. If you click on that link, you're going to come to this particular page, and you can see the different levels that we have. Level 1, option trader. Level 2 is what we discussed tonight, and that was Darknet. And level 2 is basically all of level 1 plus the Darknet contrarian system. All right, next week I'll get into what level 3 is as we talk about the money calendar and money patterns. All right, so that is the homework for tonight. Any final thoughts, questions, etc., Jay?
You're going to answer it later on in the weeks that go by as to how do people get the apps and such. So we'll let you spring that on them when it comes to that.
I will do so.
And then lots of questions again. There's some people coming in later asking about the recording. We'll reiterate what you said at the beginning. This is being recorded and it'll be sent out later this evening.
Absolutely. And next week, I'm going to attempt to teach live from the big board. And what I mean by the big board is you just got to come back to see it. And hopefully I won't be, my mouth won't be too far behind. The audio my mouth won't be too far behind the audio, but you'll see what I mean, because I'm going to actually be working off the big screen and cutting in and out on that. So I look forward to doing that with you guys. All right, so slide deck and recording will be sent to you here momentarily. And of course, you can use the exact same link to get in next week when we get into spreads, we get into money patterns, and we will do it all again. All right, guys, thank you for joining me tonight, and I look forward to seeing you next week. We'll talk soon. Bye, everyone.